Assalamualaikum and good morning to everyone. This presentation is part of our Advanced Financial Management assignment where we analyze and compare the performance of Cimb Group Holding Berhad and Public Bank Berhad. Next, moving on to our group member from section AC 3.4. The member involved in this assignment mean Nur Syafiqah Isati, Ilani binti Yuzini, Ahmad Arisman, Munira Shakira, and also Shahira binti Zulkifli. Each member contributed equally to ensure the completion of this project. Now, I will begin with the background of Cimb Group Holding Berhad. Cimb Group Berhad was incorporated in 1974 and listed in Bursa Malaysia. The group is headquartered in Kuala Lumpur, Malaysia, and offer comprehensive range of financial products and services through its core business segments. At the end of September 2025, around 33,000 staff and serve around 29 million customers across the region, highlight its intensive operational reach and strong customer base. So the vision of the group is to be the leading Asian universal bank and support by the mission advancing customer and society. Next is a Public Bank Berhad. Is one of the largest and the most established banking institution in Malaysia with a strong reputation for prudent management, consistent financial performance, and conservative risk profile. Public Bank was founded in 1966 by Tan Sri Dato Sri Dr. Deh Toh Hong Pyo on 6 August 1966. So the Public Bank started its business at the first branch, which is located at Jalan Gereja, Kuala Lumpur. So the vision is a bank for people. Public Bank vision is resilience business model of group strategy within the retail banking space, with also through public banking success story through the year. So support by the mission to sustain the position of being the most efficient, profitability and respected premier financial institution in Malaysia. Next, I will pass to Arisman.
Alright, thank you, Shafiqah. I will be presenting on analysis of capital structure, focusing specifically on the gearing ratio. I'll start off with capital structure. So, briefly talking about the definition, a company's capital structure refers to the mix of debt and equity used to finance its operations. Debt financing can be attractive because interest payment are tax deductible and ownership is not diluted. On the other hand, equity financing does not require fixed payments, but it may dilute ownership. To evaluate this balance, we use the gearing ratio, which measures the proportion of debt relative to shareholders' equity. Next, I'll be explaining on the gearing ratio. Start off with Public Bank. In the year 2022, Public Bank recorded a gearing ratio of 25%. In 2023, the gearing ratio decreased to 23%. By the year 2024, the ratio further declined to 20%, indicating a continued reduction leverage and stronger reliance on equity financing. So, for the analysis, overall, Public Bank shows a consistent downward trend in its gearing ratio from the year 2022 up until the year 2024. One key factor behind this trend is Malaysia's post-pandemic economic recovery, which improved profitability and loan repayment performance. Another important point is Public Bank's reliance on customer deposits rather than wholesale or long-term borrowing, contributing to bank's overall financial stability. Next is gearing ratio for Cimb Group. So, as per diagram shown, in the year 2022, Cimb recorded a gearing ratio at 27%. However, in the year 2023, the gearing ratio increased to 31%. By the year 2024, the ratio climbed up further, even higher, at the percentage of 35%. We'll proceed with the analysis. The rise in Cimb Group's debt for the related years can be partly explained by expansion of its commercial banking and digital business segments. Over the time, commercial bank loans climbed gradually due to increasing fund for mid-sized corporations and small and medium-sized businesses, SMEs, in ASEAN, especially in Malaysia market. Concurrently, Cimb's investment in digital banking and digital business platform facilitates higher quantities of client acquisitions and transactions. While the expansion was happening, it also inevitably resulted in increased liabilities as the bank's balance sheet grew to support these endeavors. That's all from me. Next will be presented by other presenter.
Okay. Now, I will be comparing the dividend payout ratio and dividend growth rate of two major Malaysian banks, which is Public Bank Berhad and Cimb Group Holdings. This indicator reflects how each bank balance shareholder returns with reinvestment for future growth. Public Bank demonstrates a conservative and stable dividend policy in terms of both dividend payout ratio and dividend growth rate. The bank gradually increased its dividend payout ratio from 53.97% in 2022 to 57% in 2024, reflecting management commitment to providing predictable returns to shareholders while retaining sufficient earnings to support reinvestment and long-term growth. This steady approach appeals to investors who prioritize stability and sustainability. In terms of dividend growth, public banks show consistent but moderated increases, with growth rates declining from 30.33% in 2022 to 11.8% in 2023 and 10.5% in 2024. This pattern indicates a major institution focused on sustainable incremental dividend growth rather than aggressive short-term expansion. Let's move to CIMB Group Holding Berhad. CIMB Group Holding Berhad adopts a more flexible and performance-driven dividend policy as reflected in both its dividend payout ratio and dividend growth rate. The bank payout ratio increased sharply from 43.7% in 2022 to 65.64% in 2023 before stabilizing at 65% in 2024, suggesting there are either a strategic shift toward a more aggressive payout approach or the issuance of special dividends. While this provides higher short-term return to shareholders, it also reduces retained earnings and introduces greater volatility in future dividend payment. This volatility is further reflected in CIMB dividend growth rate, which rises from 30.09% in 2022 to a significant spike of 65.38% in 2023, followed by a sharp decline to 9.3% in 2024. Such fluctuation highlights CIMB dividend strategy but also signal higher uncertainty for investors, making it more attractive to those seeking higher short-term returns despite increased rates. That's all from me.